Thank you very much. Good morning. Thanks for introducing yourselves, but I'm sure I won't be able to remember all the backgrounds, right? I can see your names. Thank you very much for that, but remembering the backgrounds probably impossible. Anyway, I will crack on. So what I will do, I will share the slides first, right? And while I'm following the slides, right, briefing on the topic we agreed, I will introduce myself as well, right? So please bear with me while I share. So thank you very much, Serene Doctors, for organizing this. Can you see the slide?
No.
Right. I think I'm allowed to share because we tested it, didn't we? So yeah. Can you see the slide now?
Yes, that's right, Shubha.
Thank you very much, right? So thank you very much, Serene, Vivek, Anup, and Ash, whoever are behind the scenes for organizing this. And thanks for inviting me for this talk, right? So I'm going to cover the most topical stuff. What I will do, the way I want to pan it out is not to, say reams of things, read out reams of things, right? And then go on and on. Instead, I will keep my initial talk short and succinct, maybe half an hour, 35 minutes. And I will encourage you all to ask me questions, right? Which puts stuff in perspective so that I can answer those specific queries. Of course, we have to be mindful that this is a common forum, so we won't be dealing with confidential stuff. But so far as dealing with generic queries, I'm more than happy to carry on, right? So I represent a company called St. James's Place. It's one of the FTSE 100 companies, right? So it's in FTSE 100 shares stocks. And today I'm covering mainly for medical professionals. When you have been introducing yourselves, basically I gathered that either you are, a forensic psychiatrist or scientist, then GPs, and also hospital doctors, consultants, right? So this is mainly meant for NHS professionals. So that's me, Shubho Kundu. And if you want to contact me, these are my contact details. Don't worry if you can't remember, because I'm sure Vivek, Anup, Ash, they have got my contact details. So if you want to get in touch for one-to-one personal advice, right, customized advice, please feel free to do so. Now, I have to say that nothing I say today is deemed as advice, because I don't know your personal circumstances, right? And these are my interpretations, my opinions about the rules and regulations, right? So these are the topics I'm going to cover. But as I mentioned, just I will touch and brief the important points, and then I will, let you ask me questions to address those queries. The first thing I'm going to touch upon is our November budget, autumn 2022 budget, because there are a few things which do impact your tax circumstances, income circumstances. Then annual allowance, which is very, very topical, and annual allowance as a package along with tapered annual allowance. And then how do you pay for the annual allowance if there is an implication? Then whether to opt for scheme pay, which are all related. So this annual allowance, tapered annual allowance, scheme pay, these are related very much, as you know. Then I will separately deal with MacLeod remedy, right? And again, a lot of the stuff you already know. So whatever, there's a knowledge gap, or you think that you need to know more about those things, please feel free to ask me. Salary sacrifice scheme, because a lot of people do ask that how does it impact? Because salary sacrifice not only implicates you so far as getting your pensionable pay lowered, but also it affects your tapered annual allowance, it affects your lifetime allowance, right? And so many other things. Then I will touch upon lifetime allowance, right? So these are the things I'm going to cover in today's brief talk. And then I will open the floor for questions and answers, right? In the meantime, if there is anything topical while I'm covering that particular topic, right, if you want to shout out, please feel free by raising your hand, or I mean, as in through Zoom, or writing up in the chat box so that I can pick it up. Because sometimes what happens is there's a question coming in your mind and then suddenly you forget about it because I'm moving on. So you can always note it down on the chat box, so that I can pick it up once I've finished talking, if that's okay with you. So let's crack on because there's loads to cover. The autumn statement 2022. Now I've highlighted the areas which may impact you. So there is no change in the 20% basic rate tax, because if you can remember, Liz Truss was trying to make it 19%, but it stays at 20. One major difference or change that has been brought in is the 45% tax threshold has been brought down from 150,000 to 125,140, and that's effective from 6th of April. So you have to be mindful if there's any, not only tax, but also if there is any annual allowance charge payable, and if your total taxable earnings are over 125,140, you'll end up paying annual allowance charge at 45%, right? And then we know that the current annual allowance is 12,000. Personal allowance is 12,570, and then 40% threshold is 50,270. They are unchanged. Dividend rates are being changed. The ordinary rate, which is the basic rate, is 8.75% from April. 33.75 is going to be the upper rate, and 39.35 is going to be the additional rate, right? There's one more thing, we all had, whoever had the companies, private limited companies, and a lot of you did that. If you've got a private practice, which can be, done routing through your private limited company, then you had a dividend allowance of initially to start with £5,000 per annum. Then it was dropped to £2,000 per annum. Now it's going to be further dropped to 2,000 and 1,500, right? So these are the changes. That means the dividend allowance is going to be reduced. So you have to be mindful of that. So from initially, currently it's £2,000. So from April 2023, which is 3 months away, it will be £1,000, and from 2024 April, it will be £500 per annum. There will be slight changes, which is not really relevant, slight changes in the rates of national insurance contributions. Capital gains tax, this is another big thing. If you sell your buy-to-let property or any stocks, or if there is any capital gain, previously, until now, until 31st of March, or if I may say 5th of April 2023, the personal capital gains tax allowance is 12,300, which will be brought down to £6,000, and from April 2023, and then to £3,000 from April 2024. So that's another big change. There is no change on inheritance tax. In inheritance tax, still the nil rate band threshold, basic nil rate band threshold, is going to be £325,000. And then if you meet certain conditions, which is if you're married, and if you've got children, and if you're going to leave your main residence, which you own, to your children, then you qualify for each spouse, if you are a married couple, £175,000. Between spouses, between a couple, the total additional residential allowance is 175 times 2, which is £350,000, provided the property you live in, the main residence, has got a valuation over and above £350,000. Then for people who are buying houses, the stamp duty threshold has been increased from 125,000 to 250,000 pound, and for first-time buyers, again the thresholds have been upped, has been increased. So these are more or less the changes which have been brought in our autumn budget. We all know about the corporation tax thing. Whoever has got companies, private limited companies, Liz Truss again was going to reduce this, but that stays. So in a slab basis, from 19%, it will go all the way up to 25%, right? The corporation tax rate. So that was all about the autumn budget. as you can see, the dividend allowance being dropped, and then the 45% tax threshold amount is being reduced. The corporation tax is going to increase. So these are the things which are going to impact you. We'll move on to our second topic, right? I'm not finishing the topic, right? I'm just moving on to different topics so that you can note down if you have to ask any questions at the end of the talk, right? So we can go back to those topics. Annual allowance. This is hugely topical and very important in all the senior clinicians' incomes and future retirement, because it not only does impact your current tax situation, but also it impacts your retirement benefits, because depending on you're opting out, if you're opting to pay directly or through scheme pay, right? So we'll cover that. Now, first of all, the difference between annual allowance calculation is between defined benefit or the final salary type of pension, which the NHS professionals are in. Then there are the teachers, police, the council workers, the civil services people. They all are in final salary type of scheme, if you know what I mean, because they are calculated through a formula. It's not stock market based. Whereas there are other people in the private sector who are in defined contribution. So that's the first determinant. And then there is another thing, whether you are in 1995 scheme or in 2008 scheme or in 2015 scheme, that also decides how the calculations are made. So now we all know that at one point in time, 2010-11, the annual allowance. So let's go through the definition of annual allowance. That means you can only contribute if you're a private sector pension holder, subject to a limit, or if you are in a defined benefit type of pension scheme, then it's not the pension contributions. Is a growth in your pension pot between the beginning of the tax year and the end of the tax year. It is also called, it has got different nomenclatures. It is also called pension input amount or pension growth. So these three things mean the same: annual allowance, pension input amount, or pension growth. So the limits have been reduced, and in particular circumstances, it can go all the way down to £4,000, unfortunately, if you have got more than the threshold amount of gross taxable earning in a tax year. We'll brief that, we'll come back to that, right? So these are the limits. So just now I briefed that in very simple term. Imagine your pension pot size was X at the beginning of the tax year, and then it is Y at the end of the tax year. So the difference between Y and X is the growth in your pension pot, and that determines. And if that's over and above £40,000, unless you've got some carry forward amount, which again I'm going to brief, right? That impacts your annual allowance charge. So I won't go into the nitty-gritties of calculating how they're calculated, right? How the pension is calculated. Either you know, I'm assuming you all know, or honestly speaking, do you really need to know? No, because you will be getting statements and you can compare those figures, right? So these are the formulas: that 20 times of your pensionable earning time plus, the tax-free cash, which is 3 times of your pension, both for 1995 section, 2008 section, and other section. But how the pension in 1995 section is calculated, it's 1/80th times the final salary times the number of years you have been in the scheme. In case of 2008 scheme, is 1/60th, right? And there's a difference between the definition of final salary. Very quickly, just to remind yourselves, final salary for 1995 scheme is best pensionable salary in the last 3 years of your working life. Best pensionable salary in the last 3 years of your working life, which out of term I'm mentioning because it will have impact on your salary sacrifice, etc. Right? I'll cover that. I will, I'll be pausing this thought and bring it up again when I'm discussing scheme pay. Salary sacrifice. And What happened? Sorry about this. For some reason, it went back to the first screen. Yeah. In case of 2008 scheme, the definition of final salary is the best of the average of 3 consecutive years in the last 10 years of your working life. So they will average 1, 2, 3, 2, 3, 4, 3, 3, 4, 5, 5, 4, 4, 5, 6, etc. and then find out which average is the maximum. But these are all pensionable salaries. In case of 2015 scheme, the accrual rate is 154th. And it's not the final salary, it's a career average, revalued earnings, right? And of course, there are other differences also, like pensionable age 60 for 1995, 65 for 2008 scheme, and state pension age for 2015 scheme. But I'm assuming that you are aware by this time. You are aware of this. A very simple calculation. Imagine somebody's best salary in the last 3 years of their working life was £120,000, and they have worked with NHS in the 1995 scheme for 35 years. So by applying the formula, which is 188th times the number of years they have been in the scheme, which is times 35, times their final salary, which is the best salary in the last 3 years of their working life, is £120,000. That's their pension, which is 52,500. And 3 times of that amount will be their tax-free cash lump sum, which is 157,500. Now, I'm not going into these. I'm not going to read the slide by slide, but there's a difference how GPs. So the calculations I was discussing were for hospital doctors, the consultants, right? The calculations for GPs are different. They always were in career average earnings, right? They always were in career average. Just the formulas differed for how much was it through 95 scheme or 2008 scheme or 2015 scheme, right? A brief discussion about pension input amount, which I tried covering. Again, I'm not going to go into the details of it. It has got a very complicated formula. Right? Some of you may be interested, so I'll just spend 30 seconds probably or 1 minute on this. If you know your pensionable earning at the beginning of the tax year and pensionable earning at the end of the tax year, so PE means end of the tax year, CE means tax-free cash at the end of the tax year, and PB means pensionable earning at the beginning of the tax year, then it's basically 16 times pensionable earning at the end of the tax year plus tax-free cash at the end of the tax year minus 16 times pensionable earning at the pension at the beginning of the tax year plus tax-free cash at the beginning of the tax year. But the second bit has to be multiplied by the CPI, right? So that's why you can see that the consumer price index or the inflation rate plays havoc, because it is very important part of the formula. You don't need to know this. Sorry, I'm not trying to deliberately complicate this, but this is how it is calculated, and that's why we are more interested in knowing how much is the total growth. So that's how you're tapering. I'll come, because in one of my slides I've given an example how your annual allowance statement or pension growth statement looked like. I'll come to that page, but before moving on, let me look into the third topic, which is tapered annual allowance. Now you may think that why 2019-20 is still relevant. It is relevant and it may not be relevant. Let me just explain why. If you're a doctor or NHS professional in England and Wales, not Scotland, right? In that case, if you can remember, in 2019-20, government made a rule where the trusts were picking up the bill of your annual allowance charge. That means you are given the opportunity to fill in certain forms if you had some annual allowance charge payable for the tax year 2019-20, right? And then you filled in the form for scheme pay, but you never had to pay it because the scheme wouldn't deduct from your pension pot. Rather, that bill along with the interest and everything will be picked up by the respective employer or the trust, right? So until 2019-20, there was a difference in the threshold amounts. Until 2019-20, if your total taxable earnings, now when I say total taxable earnings, it does include your NHS pay, your property rent, your other dividends, other interests, other incomes, if you've got some private income, etc., etc., everything put together, everything added up, that constituted your total taxable pay. If that went up above £110,000, then you had to add your pension growth on top of that. And if that second figure was above £150,000, then for every £2 being £150,000, £1 would be reduced from your standard annual allowance of £40,000. So that table shows, respectively, if you've got, say, £160,000 of taxable earning, then how much your annual allowance charge would be. If that 160,000 figure is your pension growth plus your taxable earning, right? If you are above £210,000, your tapered annual allowance will be 10,000. It can't go below that. That was an absolute minimum tapered annual allowance. And then things were changed from 2020-21, which is a current regime, this is the current regime. So if your total taxable earning goes above £200,000 in a taxable tax year, then you'll have to add your pension growth amount on top of that. And if that final figure is above £240,000, then for every £2 being over £240,000, £1 will be reduced from your standard annual allowance. And it can go all the way down to £4,000. So if you're earning, lot many GPs and hospital doctors, especially who have got private incomes and other things, right, senior doctors, they have got total adjusted earning, which is your pensionable earning plus any other taxable earning, plus, NHS taxable earning, and then any other taxable earning, plus your pension growth, and it's over £312,000, right? Then your annual allowance is tapered to £4,000. And as it says very briefly, your salary, bonus, commission, dividends, property income, bank interest, pension contributions, everything is included in calculating your total taxable earning. Now, this is how usually your pension growth statement, some of you jokingly call it brown envelope, right? Shows. This is how the statement looks like. So imagine this is for 1995 section, right? This is an example template. And in 2021-22, the growth was £23,000. In 2021, 13,000. In 1920, it was 26,000. And in 2018-2019, it was 42,000, right? This is one part of the story. You'll have to add your growth figures for 2015 also on top of these. And then get to the final figure, that this 23,000, and on top of that, if you add your growth in the 2015 section, how much is the total amount, and if that takes you above 40,000 or not. So that's how the impacts are. Now, there are various calculators. One of the calculators which I use, right, this is typically, so if you put all the pension growth figures, right, now you know that one can carry forward last 3 tax years, unutilized annual allowances to offset any excess annual allowance this year, any excess pension growth this year. So it has got a knock-on effect on future years, and that's why it's very important that you have the details from as early as possible, because they may have knock-on effects. So if you just take a cutoff and calculate your, say, hypothetically from 2016-17 onwards. Now, if you had some excess growth in 2016-17, you need to know how much was your 12, 13, 13, 14, 15, 16. So that's why it's important that you go back as early as possible and then put the figures in some table, and then finally you get a final table like this. So these red figures are the excess amount even after adjusting your carry forward amounts, and this also factors in, if you can look at the top, 1, 2, 3, 4, fourth row, or maybe sixth row, the threshold amount, threshold earning, and the adjusted earning. for this particular example, the adjusted earnings are way above the threshold amounts, right? And that's why when this table shows up, it not only considers your carry forward amounts, if there is any, but also your tapered annual allowance. And these are the final excess amounts. So it's very important then to decide how you're going to pay, right? So, but before you do that, you'll have to file the returns. Now, I'm not a tax consultant. Your accountant will do that. But just to give you a flavor, that once you know that you have got some excess amount, even after adjusting your carry forward amounts, etc., there are two tax return forms. One is SA 100, and then there is an additional information form which is called SA 101. And in form number SA 101, page number A14, if you look at number 10, point number 10, that's where amount saved towards pension in the period covered by this tax return in excess of the annual allowance. So all the information goes over here. This is just to give you some information on this, right? It has got nothing to do with me. You have your accountant to sort all these things out. So next, the question arises that who will pay the annual allowance? Is it you, or are you going to opt for scheme pay, which is again you, but at least you can defer it. How will you pay the annual allowance charge? Now, if you have got annual allowance charge payable on an amount of £2,000, so your annual allowance charge is £2,000, then you have to pay it from your own pocket. That means any amount up to £2,000, you have to pay it from your bank transfer. But if your annual allowance charge is more than £2,000, then you have got two options. You can still pay it upfront from your account, or you can opt for scheme pay. You all know by this time what is scheme pay. In very brief, if I have to describe it, if you want to defer your annual allowance charge payment, sometimes the bills are very big. So if you want to defer it, then you fill in this particular form. It's called SPE2, form number SPE2, which is, as it says, annual allowance scheme pay election. So if you elect this, you have to fill this form in, and then what it does, you don't have to pay upfront. You still have to fill in form number SA 101 to show that you've got a liability, and instead of paying it by 31st January or 31st of July, you fill this form in by 31st of July so that your pension manager can deduct the annual allowance charge plus any amount of interest payable on that directly from your pension pot when you retire. So you'll have to calculate which one is better for you, because it's not free of interest. There will be interest on top of this, but does it help you to be deducted at the end of your working life from your pension pot, or is it make sense to pay it upfront? So those are the sensitivity analysis you'll have to do. And these are the bullet points. That means, any type of large pay, sometimes you get a reward or some excellency award or some clinical directorships for a couple of years or whatever it is, right? So any additional income which are pensionable, that may trigger the big annual allowance growth, and hence maybe potentially annual allowance charge. You have to look into your last 3 years carry forward, and then if you can't avoid annual allowance charge, definitely you have to pay some. Then you'll have to decide whether you want to pay it upfront or you want to pay it through scheme pay. And what are the remedial actions? Now, there are different types of remedial actions, some people stop working pensionable earning provider jobs. Instead, they go more into say taxable but non-pensionable types of overtimes and on-calls, if that is possible. Some people create a private limited company. I'm not a big fan, but some people also do hokey cokey, that means opting out and opting in for a shorter period of time. Everything has got its own implications, so you have to be very careful and look into the solution which you're opting for in totality, right? Very briefly, because it's pertinent, it's relevant for 2020-21, the deadline for what is voluntary election. So if your growth in the 1995 section or the 2008 section or the 2015 section individually in isolation is more than £40,000, right, then it's mandatory. But if in total, if you add the total growth across the schemes, because you can only be in two schemes at a time, 1995 and 2015, or some of you 2008 scheme and 2015 scheme, if you add the growth in both of them and then you go above £40,000, then it's voluntary election. But if you individually have crossed £40,000 through your 1995 scheme growth and or 2015 scheme growth, then it's mandatory. It's not voluntary election anymore. And that for this 2020-21 is been moved up to 31st of March 2023. Yes, I do agree, fully agree. Things are not easy. These are very, very complicated calculations. And that's why it's important, because at the end of the day, it's impacting you not only currently, so far as your taxes are concerned, your take home is concerned, but also your retirement pot, right? Because you are currently you are having the ability to go out and work more and maximize your earnings. But when you're retired, if you don't want to go back to your work, then everything is fixed. And then suddenly, if you have to pay more through scheme pay or other things, right, then it really, really, pinches you. So you have to be very careful, not only about now, the current time, but also about your future. So let's move on to the fifth topic, which is MacLeod remedy, right? And in nutshell, it is called the deferred choice underpin, the period between 6th of April 2015 and 5th of April 2022. So when you retire, not now, when you retire, you'll be given the option of choosing that how do you want your deferred choice underpin, or in short form DCU period, to be going into your 2015 scheme or 1995 scheme or 2008 scheme. So 1995 and 2008 scheme are reckoned as legacy scheme, and 2015 scheme is a new scheme. So between your reform scheme or legacy scheme, you'll have to opt that which one you want to be in, and that option will be given to you not now, but at the time of your retirement. Then so this period is called the remedy period, but it doesn't come without any implications, because if you choose one or the other, it may have some beneficial or adverse effect on your annual allowance charge and lifetime allowance, because the calculations are totally different for 1995 scheme or 2008 scheme and 2015 scheme. So you have to be careful which one you opt and how do you opt. Now, there is no blanket decision or rule that which one scheme is by default better one. It can be dictated by individual circumstances. Some people who want to carry on working until their state pension age, it might be so that a particular scheme, say a 1995 scheme, is not beneficial. Probably they want to be in 2015 scheme because the accrual rate for 2015 scheme is higher, 154th. Whereas people whose priority is to retire as early as possible, as close as possible to the age 60, for them any financial benefit may not be that relevant. They probably want to maximize their contributions or their period, number of years in 1995 scheme. So again, a sensitivity analysis will be required. So you have to be very mindful that what do you do and how do you choose the one which is beneficial for you. So these are the implications. There may be some additional annual allowance charge to be paid depending on you're moving from 2015 scheme, because by default currently that underpin period, deferred choice underpin period, contributions are going into your 2015 scheme. Now it might be so that you chose to remain in that, and that's fine. But if somebody chose to convert that into that deferred choice underpin period into 1995 scheme, then it might be so that you end up having some more annual allowance charge to pay or more lifetime allowance charge to pay. Then you may have to pay the additional amount. Now, there is a remedial or complaint process, that if somebody is adversely impacted, what is their recourse? Can they complain? So the government, the Treasury, was supposed to bring the consultation decision on 6th of January 2023 on this particular issue. But unfortunately, around November 2022, they said that they won't be able to do that. And they're only going to bring the MacLeod remedy consultation final paper by October 2023. So we'll have to watch the space. I did mention that we will cover salary sacrifice also. I'm mindful of the time, but I've got another 5 minutes worth of talk, and then we'll move on to the question answers. Salary sacrifice is basically using your gross pay, part of your gross pay, to pay for certain things which are allowed. So what are the allowed stuff by NHS? Childcare vouchers, cycle to work scheme, car hire lease, which is the most common one, carpool lease, NHS carpool lease. GPs are not doing this allowed, but hospital doctors, they are doing this. On-site nurseries, home computers, car parking, gym membership, etc., prepaid store cards, personal learning. So these are all allowed to be part of the salary sacrifice scheme. The bullet points about pros and cons about this is that if you opt for salary sacrifice, your pensionable salary goes down, so does your taxable salary, your benefits go down, right? Your death in service benefit goes down, your sick pay goes down, right? Your pension growth is reduced. Now, some people may say that it's beneficial because you are having annual allowance charge implications, right? But it does go down. Those are the implications. But tax efficiency, yes, that's the benefit, and that's why people do it. But you have to be, again, very careful. Again, there is no blanket answer that is going to be definitely beneficial for everybody and anybody. No, it's not like that. So you have to do your own calculations. And this is our last topic, which is lifetime allowance. Again, on this one, historically, the goalposts have been moved a lot of times. At one point in time, until 2010, 1.8 million was the limit, and then it was brought down in 2016-17 to 1 million, and then they linked it to the inflation rate, and then from 2020-21 it has been frozen to 1.0731 million. So what is your lifetime allowance? And some people do ask me that what is the difference between, and a very rudimentary question. Lifetime allowance is when you are retiring, when you are drawing pension from your pot, be it a private pension, be it the NHS pension, or both, your total pot size will be calculated. Now, in case of final salary schemes, there is no pot as such. So you have to calculate your deemed pot size. So there's the calculation of your deemed pot size is so-called pension, the calculated pension times 20, and then add the tax-free cash on top of that. That's your deemed pot size. And that will be, if you've got more than one scheme, then the deemed pot size across both the schemes will be calculated and then added up. And the final amount, plus if you've got any private pension, that fund value as on your retirement date will be all added up and clubbed up. And that X figure will be compared against the standard lifetime allowance prevailing at that particular point in time. So if, as of now, since it's 1.0731 million, imagine you're retiring today and your pot size is 2 million. So the difference between that 1.2 million and 1.0731 million will be your excess amount over and above the standard lifetime allowance. And on that bit, you'll end up paying lifetime allowance charge. And there are two ways you may be charged. That lifetime allowance charge may be charged. If you opt to take the excess amount, excess over 1.0731 million, so the difference between 1.2 and 1.0731 million, that excess amount, marginal amount, if you want to take it as cash lump sum, then there will be a tax implication of 55%, and they will pay you the 45% of the difference between 1.2 million and 1.0731 million. But if you say that I will only take the 25% tax-free cash, which is I'm allowed to take as tax-free, then, and the rest as income, then they will deduct 25% from that excess amount, 1.2 million minus 1.0731 million in this particular example, and then put the rest for you to draw income. But again, you'll be paying your income tax on that additional amount. Now, it has been seen that if you remain 40% taxpayer, even after your retirement, then there is no difference for you whether you take it as lump sum or you take it as income. In both occasions, you end up paying a deemed tax rate of 55% or so. So, how the historical reduction in the lifetime allowance, reduction has impacted your situation at retirement. We don't have to go historically to 2010, even in 15-16, when the maximum lifetime allowance was 1.25 million, one could have had a pension of 54,000 and tax-free cash of 163,000 pound, right? And still be just around 1.25 million and didn't have to pay any lifetime allowance charge. But now, since this reduction, for simplicity's sake, I've kept it to 2016-17 level, which is 1 million. You can only have 43,000 pound as pension. From 54 to it has gone down to 43 and 130,000 tax-free cash lump sum, and still hit the lifetime allowance. So previously you could have had 54,000 without any lifetime allowance, but currently you can't have 54,000. If you have 54,000 of pension, you're 11,000 over and above the 43,000 figure, and that means you'll end up paying lifetime allowance charge. So it has reduced the amount you can have without any lifetime allowance charge payable. And this is a typical example of your pension benefit statement. Mind that one is called pension growth or pension input or annual allowance statement, and this one is called pension benefit statement. This one is available through TRS, your total reward statement, or your depending on whether you access through TRS or your employer's website. So there are two options. Either you can go through gov.uk website or through employer's website. Either way, you can get this pension benefit statement. But annual allowance statement is not available online through these websites. If you only trigger, that means if you go above 40,000 pound, right? That's the way it is. Sometimes they may not send you, but that's a lapse, right? They're supposed to send you one, NHS BSA is supposed to send you one. If you've gone above 40,000 pound in a particular tax year, then they will send you. But unfortunately, since the onus is on the pension member, if you don't receive one, historically, I've seen with my clients that, they had some implications, but they didn't receive the annual allowance statement. So they couldn't calculate the implications. So since the onus is on you, you have to ask for one. If you think that there's a high possibility or there's potentially you've gone above 40,000 pound, then you should ask NHS BSA to send you your statements, right? If they don't send, nowadays, it's not safe to assume that there is no implications, right? So I would encourage everybody to ask for one. So you can quickly calculate. Now, before I stop the talk, very quickly, I'll let you know that there are two ways your lifetime allowance spot can be calculated. One is, if you have looked into let me go to the first page. So there are two figures. If you want the full pension and the usual lump sum, then these are the two figures, 46,000 and 140,000. But in your same statement, you'll find out another set of figures. So if you take reduced pension of 37,000, but higher lump sum, maximum lump sum is 251. The figures are different over here because these are all made up. So imagine without the deduction, the pension was 39 and the tax-free cash was 119. Then the pot size was this. And then the same person had this much, a small amount in 2015 scheme. So the total pot size was 964. But if the person decided to take the maximum tax-free cash lump sum, which is instead of 119 to 2014, 214,000, with a reduced pension from 39 to 32, then the total pot size is reduced. So instead of 964, it is now 894, right? So that is another way of reducing implications on lifetime allowance, right? This is just to say that what are the remedy, but unfortunately there is no remedy if you go the standard lifetime allowance now. If you had some of the very senior clinicians or GP who had their pension pot over and above the 1 million pot, as in end of March 2016, they still have one protection option available. So what is protection? Historically, whenever if you remember the slide, that the lifetime allowance amounts were brought down from 1.8 to 1.6 to 1.5 to 1.25, 1.0. Whenever they brought the change in, people who were already above that newly recommended amount, they were given a window that you can put some protection in place. So the last protection available was made available in 2016 when the last change was made, it was reduced from 1.25 million to 1 million. So people who had their total pension pot above 1 million as on 31st of March 2016, they still have one lifetime allowance protection available, which is called individual protection 2016. That's all you need to know. But if you have got any serious implications, you'll have to do further digging into it. So you have to be mindful of qualifying whether you have gone above lifetime allowance and how much is that amount. If you are a member of added years, additional pension, AVC, because when I discussed about different remedies, one of the remedy for mitigating or managing lifetime allowance is that you may decide, provided it's favorable for you, to drop your additional added years contributions, right, or additional pension contributions or personal pension contributions. Look at whether you qualified for any lifetime allowance protection or not. Effect of scheme pay, because scheme pay is taken from your pot, so it de facto it reduces your pot size. Hockey cokey, which is coming out and getting into pension contributions, and then fund pension contributions to different members of family instead of yourself. Look at other tax wrappers. So that's all so far as the topics are concerned. Sorry, it took me almost 45 minutes to cover all this because there was a lot to cover. So now I throw the floor to you all to ask me any questions that you may have.
That's great, Shubho. Thank you very much for a fantastic recap of things and telling us where we stand. Some people have put questions in. I would encourage everyone who has any questions, even if they are very small questions, to put in the chat box so that we could put it to Shubho and see what his views and answers are. The questions actually clarify a lot of confusion and information. So it's a good way of understanding where we stand. So the first question which came through was, what will be the impact of high inflation on annual allowance this year and maybe the next year or two?
Yeah, Ashish.
Hi, Vivek.
Hi there. Sorry, sorry to interrupt. Shall we give Shubho a couple of minutes to take a breath and go through the questions?
Yes, I can do that, right? And that will all give us a little bit of stretch break. So how long will it be? A couple of minutes, 5 minutes? What do you
Yeah,
prefer?
Shubho, if you go through questions, meanwhile, I will introduce all the people who have joined, myself as well as what we are, who we are, and what we do. So that, and meanwhile, you can have a look at the questions, please, if you don't mind. And I'm pausing the recording for the time.
The 2015 scheme. You'll have to join in the 2015 scheme from 6th of April 2022. But the period, that 7 year you have mentioned between 2015 and 22, that's the period you'll be given the option either to be in the current legacy scheme, which is 1995 or 2008, or the reform scheme, which is 2015 scheme. Unfortunately, in the way lifetime allowance statement looks like in England and Wales, you have to calculate your own lifetime allowance. But in Scottish statement, SPPA, right? For the lifetime allowance is given in the last page for the annual benefit statement, NHS annual benefit statement given by the SPPA. But in case you are a doctor practicing in England and Wales, you'll only get the pension figures, and then you'll have to apply your own calculations and calculate it on your own. Yes, unfortunately, Vijay Kudari has asked that lifetime allowance seems a guessing game. Yes, since you don't know how much your growth in the pension pot would be next year and the year after and the year after until now and when you retire. So it's very difficult. For the 1995 section or the 2008 section, at least you can make some guesstimations or more, I wouldn't say accurate, but more realistic estimations. Because you may know how many years you have been in the 1995 scheme. Even if you opt another 7 years through the deferred underpin choice, you can add another 7 years on top of the number of years. And if you're a member of the added years, you can factor in that how many years you've bought in, say 9 years, for example. You can add all those up and then use the formula 1/80th times the number of years you have been in the scheme, and then the final salary. You have to guess that what is going to be your best salary in the last 3 years. And you can find the 1995 section pension amount. And once you know the pension amount, you can calculate, you can use the formula times 20 plus tax-free cash lump sum, and you can get to the estimated amount of your lifetime allowance in 1995 scheme. Similarly for 2008 scheme. But 2015 scheme, since it's career average, revalued earnings, it will be very difficult for you to find out what's the average going to be. So I fully agree, Vijay, that it will be a difficult task to calculate how much your lifetime allowance pot will be by the time you're ready to retire. Yes, the way of knowing your lifetime allowance is as of now. You can't future project. As of now, you get the statement. If you're a Scottish doctor, then of course you'll find it out in your annual benefit statement, which is a pension benefit statement through TRS. But if you are not practicing in Scotland, if you're practicing in England and Wales or Northern Ireland, in that case, you'll have to find out your figures from the TRS and then apply your own calculations. Rinku, you have asked that whether your understanding of annual allowance to be paid from your own pocket if the annual allowance under 2,000, it's annual allowance charge under £2,000. But if your annual allowance charge, after all the final calculations and everything, is over £2,000, then you can choose for scheme pay, or if you still want, you can pay it from your own pocket. If two doctors have the same size of pension pot, say 1 million, do they get the same pension per month? It may not be, because they may have, after all the final calculations, the total pension pot size as 1 million. But first of all, you'll have to see how much of that pension pot is coming through 95 scheme and how much is going to be from 2015 scheme. That's the first difference. One may have smaller amount from 95 scheme, but higher amount from 2015 scheme, and that differentiates the situation. Second is, one may have gone for the maximum pension and the usual tax-free cash lump sum, but the other may have gone for reduced pension, and maximized tax-free cash lump sum. And after that, his or her pot size is 1 million. So those are the differences that still can exist, though their pot size may be 1 million. How many years we need to stay in pension scheme or pay NIC to get full pension benefit? Right. The state pension, which is generated through national insurance contribution, the maximum number of years you can pay national insurance contributions is 35 years. This change was brought in 2016-17 to qualify for the maximum national insurance, the old age state pension is 35 years. Previously, it used to be 30 years. Secondly, you only qualify for state pension provided you have contributed national insurance contributions for a minimum period of 10 years. So if somebody came from a different country and had been working in UK for less than 10 years and have been contributing into national insurance for less than 10 years, unfortunately, they wouldn't qualify for any state pension. In that case, I would encourage them to consider topping up their national insurance contribution through voluntary contributions. And in case of NHS pensions, it is calculated through formula, be it 2015 scheme or whatever. In case of, say 2015 scheme, 154th times the number of years they have been in the scheme times their career average revalued earnings. How does one acquire a pension growth statement going back many years? So you'll have to write or email or call up NHS BSA if we are talking about England, Wales, Northern Ireland, otherwise SPPA, and request them for your old annual allowance statement. By default, you get last 4 years. So this year, say for example, the one you got around between August and November 2022 was for the years 21-22, 2021, 19-20, and 18-19. If you want older statements, you'll have to write to them. How does one fund pension contributions to spouse from their NHS pension? Unfortunately, you can't. The only way you can, contribute into your spouse's or children's pension schemes would be if you got a private practice income through a private limited company. That company can contribute into not NHS pension, but a private pension for your spouse or children. But directly, if you don't have a private limited company, you want to pay from your NHS contribution, you can pay from your net salary to your spouses, for example. You can only pay subject to these two, whichever is, higher. So if the person doesn't have any income, I'm talking about the spouse, then a maximum of 3,600 gross per annum. Or if the person has got some pensionable earnings, then whichever is higher, subject to a maximum £40,000. So you can contribute into spouse's pension from your net pay, from NHS earnings, but you can only pay subject to those two limits. Are we still allowed to buy added years, Satish Singh? No, Satish, you can't. If you were a member of 1995 scheme and had opted for added years and have been contributing, then you can continue doing so until your contract finishes for the added years. But if you didn't do that, and then 2008 scheme was introduced from April 2008, then unfortunately you lost the train. You can't do it now if you hadn't done it before 2008. Rinku, you've asked, do locums GPs have death in service benefit of pensions if they pay into pension scheme? If locums, different types of locums, as I understand, are there agencies and direct, locala and stuff like that. If you're allowed to make contributions into pensions, then yes, you do have, because having the membership in the pension scheme, NHS pension scheme, buys you or make you subscribe to the death in service benefit. But if you, in your situation, if you can't join in some NHS pension scheme, then unfortunately you don't have the death in service benefit. Then the next question from Rinku again, can you utilize company money to be put into pensions even if your income from company is Probably you meant 12,500. Yes, because companies don't have personal allowance. Company can see if you are, say for example, your spouse is one of the directors or employees of or shareholders of the company. The company either directly from the company's contribution can make contributions into your spouse's pension, or your spouse can draw income from that company and contribute as personal subscriptions or personal contributions. So the company directly can make contributions, as well as the person can draw his income and then make some contributions. The answer is yes. What happens to pension if one works in NHS for 12 years and then moves from independent into independent sector and has private pension? It's frozen. So nothing goes away. You don't lose it. It's frozen until your normal pension age of the scheme, NHS pension scheme you were in before leaving it. So had you been a member of 1995 scheme, it's frozen until age 60, and then you can start drawing from it. Having said that, you've got the right to draw from it starting from your minimum pension age, depending on your age, 55. But if the normal pension age of that particular NHS pension section scheme is 60, you want to draw it from age 55, then there will be some actuarial reduction. So you have to be mindful of that. If you're a member of 2008, then you can start drawing it from 65, so it will be frozen until 65. And similarly, if you are a member of 2015 scheme, when you are going out from NHS and joining independent sector, then it will be frozen until your state pension age. Then I can see another question. One can't choose, Vijay, you've asked, one can't choose how much pension contribution to make other than hokey cokey, meaning that one is either or is in or out. Is that correct? Yes, you're absolutely correct. That means you guesstimated and found out that you will be over your not only standard and or tapered annual allowance, but also you would have exhausted all your carry forward amounts. And to arrest the growth in your pension pot, you opted out of pension for 3 months, hypothetically, say the last 3 months of the tax year, so that your contributions were only for the 9 months period out of those 12 months, and that would have impact in the growth of your pension pot. And then again from April, after the finish of the first 3 months, those 3 months, you can join in. So this is hokey cokey. You're absolutely correct. Since we are discussing this, you have to be very, very careful, because during the hokey cokey period, when you are opted out, you lose the death in service benefit and so many other benefits, right? The next part of the same question is, one can't choose how much pension contribution, meaning that one is either in or out. That bit I have answered, but in a defined contribution scheme, one can determine exactly how much pension contribution to make directly. Yes, because it's not the pension growth, it's the contribution, actual contribution amount. If your employer also contributes, then it will be the sum total of your contribution, employee's contribution, and employer's contribution. It's very simple. If you know that the current, until a particular month, you have already contributed £40,000, you just stop your contribution till the end of the tax year. So yes, I agree with you. Then Ash, you've asked, Yes, thank you very much, Ash, for answering it. Rinku has asked, do you need to let PCSE know that you are opting out for the year or two? Yes, you have to write to them, they have to agree to this. You can just opt out or cancel the direct debit, because it's not through direct debit, it's they deduct it from your gross salary, don't they? So you'll have to fill in certain forms. And then which form to fill in to opt in, opt out of pension, and which benefits will be lost. So I've already said death in service, sick pay, then your salary will be reduced. So if you're trying to take mortgage or anything, it will be reduced, right? So your taxable pay also will reduce. So these are the 4 different things. You lose out. What form to fill in? If you type in NHS Ask, ASK, if you go to NHS BSA website, and there's a drop-down menu. If you click on that, there's a place called Ask. It's like a search bar, and if you type opting out form, it'll bring up the form. Or even in Google, you can search it, right? So that's all I can see for now. So thank you very much. If is there any other question?
Any burning question, because we're just 1 minute left.
I have one question, if that's okay, and I'll keep it short.
Yeah.
McLeod's, you could go back and decide what you want to do later on, which is close to the retirement. Now, suppose I paid about 10,000 annual allowance charge 3 years ago, and I get the McLeod figures next year, but you're saying I have to decide it at the time of retirement. Now, my understanding is our tax records or the calculations get logged after 7 years. You can't really change it. So would that be built into McLeod that you could still go back and change your tax records when you retire?
Yeah, brilliant question. And these are precisely the nitty-gritties they're discussing before finalizing the consultation paper, right, which has been delayed until October this year, right? Because they're supposed to answer those questions. A lot of doctors who are going to be impacted by their choice through McLeod remedy, especially the doctors who are very close to their retirement age, right? They know that they currently don't know the tax situation. Suddenly, when they retire next year or the year after, right, there may or may not be some additional tax to pay. So they wanted to know before they can make up their mind. Whatever little benefit they have, that might be lost through the additional tax charge to be paid. So that's why, but NHS BSA or government is not in a position to answer those. So Ash, we will pause that thought. Hopefully these are going to be answered through the final paper in October. Is that okay? Hello, can you hear me?
Ashish?
Yes, that's great. Thank you very much. Thank you.
Thank you. Sorry, I couldn't answer it, but yes, that's
good. At least they're thinking and you're thinking and you're lobbying for all those answers. Yeah.
Yes, yeah.
I see there's a lot of interest and everybody is still here. We can extend by 5 minutes. If anybody has burning question not answered and put it in the chat, can they shout it out first? Because I think in the interest of time, it'll be better if you speak it out.
There's one more question. Pradeep Pardeshi has written pension versus investment. Sorry, there are a few more, while we were discussing. One last, opting out decreases taxable salary. It does. Vijay, you have asked, opting out increases taxable salary. No. It does, right? Okay. Let me properly discuss it. If you're opting out, your gross pay goes up, right? So obviously your gross pay goes up. So does your tax bill, because the contributions made towards the pension was tax efficient, but you'll still get slightly more income since you have opted out. So your taxable salary goes up. Your tax bill goes up, but still you end up having slightly more, net after tax pay. Now, since there is a linked thing with this, there is a current in Scotland, instead of in 2019-20, instead of asking the trust to pick up the annual allowance charge bill one-off for that tax year, they didn't do that. Instead, they gave the liberty of recycling the employer's contribution and pay them as additional salary to the member if they opted out, right? So recycling means otherwise, if you opt out, you lose out on the employer's contribution into a pension if you're a hospital doctor, right? So instead of losing it out, the employer will pay that to the employee, but since that will increase your taxable pay, you'll have to pay tax on that, right? But still, it will be some additional gain. Currently, in England and Wales, out of the many things they're discussing, this is also another thing, whether that's doable or not, because that 2019-20 trust picking of the bill was one of things. They are not going to bring it most likely. Instead, they're going to resolve the problems through different types of combinations of different things. One of them they're considering is the recycling of employer's contribution. And pension versus investment, it's comparatively, what should I say, complicated question, depending on the type of investment. But one big thing, if I read this as NHS pension versus investment, I have probably out of the 23 people I'm addressing now, many of you are my clients, existing clients, at least some of you. You know that I'm a great fan of NHS pension scheme because of three things, many things, but mainly three things. NHS pays you guaranteed pension, because even if the stock market crashes at the time of your retirement, you still get the NHS pension. Two is, when you retire and start drawing your pension, you still, your pension still goes up by inflation rate, CPI. So it's inflation proof. And three is, there's a spousal benefit, which is 50% of your pension. And that's why. So the guarantee part is not there in any private investment or in private pension. In private pension, you get the tax relief. There's the fourth thing, in any type of pension, be it NHS pension or private pension, you get tax relief. If you're a 40% taxpayer, you only need to put in 60 quid if you want a total 100 quid in your pension pot going in. In investments, barring some investments like enterprise investment schemes or venture capital trusts, you don't get any tax relief, and there is no guarantee. It's up to the fluctuations in the stock market. So you're taking a risk. But at the back end, when you retire, when you're drawing from your NHS pension scheme, it's treated as salary and you end up paying tax on it, right? And in the investments, especially if it's ISAs, you get to draw any income or capital free of tax, right? So that's another difference between these two, pension and investment. Pension is stuck until the retirement age, investments isn't. So that's another difference. Is it worth, Renuka, you've asked, is it worth taking dividends or payroll income from a limited company up to basic salary of £50,000? Yeah, depending on how much your existing income is. If you're in his, GP or doctor, if you've got other incomes, right, then probably not, especially if it impacts your annual allowance charge and other things. If it takes you above 100,000, you remember, you start losing your personal allowance the moment your taxable earnings touches 100,000 plus. So it's individual situation based. In Scotland, they are again offering recycling this year. Fantastic. Thank you very much, Emma
Can
Gurwal.
everybody answer the poll as well? And Shubho, carry on. Sorry to interrupt. Can everybody answer the poll as well so that I can release it before we end in next 2-3 minutes?
I can see from Emma Gurwal. So thanks for confirming that recycling is still available in this tax year. Anuj, you've asked, is it possible to contribute to a private pension like SAPE from limited company funds? The answer is yes, right? So Ram, I think your first name is Ram. So yes, you can contribute from, because as I mentioned, there can be employer. In case of a limited company is becomes your deemed employer. So there can be contribution directly from the limited company, or you can draw that as income depending on your tax situation and contribute that as your personal contribution. But yes, the answer is yes. The company can contribute into a personal pension or SIP. So that's it from me. If there is no more question, but feel free to contact me. If you know my contact details, I've got my website and everything, which I had shown you before, right? So, and
I can share with you that I purchased a product from Mr. Shubho for my wife for her pension because of the investment or the pension scheme she had. No scheme she had actually. And that is what, but in return I get the benefit of getting the idea about the NHS pension advice as and when I need, despite not investing anything on my name, because when you do for your any family member, you get all the advice, which is an advantage and which is a big saving if I would go into private or anybody else in individual. That will cost me much more heavy than I pay. And instead of that, I'm getting it as a member of investment for my wife, as for the whole family. So that's very interesting. And it's a kind of a big, I'm getting my money back as well for my wife. And at the same time, I'm saving money by not paying anybody, because Shubho will give us the entire opportunity and privilege through the system. And I can see only 11 people have answered the poll. Please do that in next 30 seconds so that I can show it to everybody, and Shubho gets the feedback about how lovely his presentation has been in real tangible terms. Thank you. Over to you, Shubho. You finished after we.
Yeah, there are a few members requesting for my contact details. You can have it from Anup, or Vivek, or Ash. I think Ash has got mine. Otherwise,
Please feel free to put it on the chat box also.
which I have done now. Just recently, I've done twice. My email address. Nowadays, all you need is email address or mobile number, or you can type my name, Shubho Kundu, for my website also. Right? Okay. So.
Here comes the poll results. As you can all see, 12 people have answered, rest been bit lazy. So it's 5 people, 10 out of 10, 6 people, 9 out of 10, 1, 8, and only 1, 5 out of 10. So amazing presentation. And thank you, everybody. And please feel free to go into the chat box and be generous to contribute something for our efforts we are putting for all the service for you. But of course, you can give it further, because that's how the whole world moves. Somebody helps us, somebody helps you, then you help somebody else further, and then it returns back to you in a cyclical manner. That's what it is all, because we all are recycled, living forever. That's how I understand. And as you can see my lovely t-shirt. Can you? The world family. So be the one world family, and do feel free to contribute for Ukraine relief. And we'll have many such projects to support in the future. And I'm stopping the recording now. People who may like to leave, please feel free. I know it's a Sunday. You got